if I could start with you. Thanks a million for coming on this morning and joining us and giving us your time. Before we get to Elkstone, tell us a little bit about you. Tell us about Alan. How did you end up where you are today?
Well, look, I'll race through it because otherwise we could be here all day. But look, I've had many chapters in my career, in my life so far. So I would have started with PwC and did well there. Was a partner in PwC Ireland, ran the financial services practice, primarily in the banking space. Left at a young age, 35, and I joined EBS, the Building Society, where again, I was fortunate in that I was one of the executive directors there, and at an early age, probably got far too much responsibility, but learned a lot as a result of that. So I was there between 2005 and 2009. And then post that, I ended up working for a guy called Roger Jenkins, who had been a star banker globally in Barclays. He'd set up iShares and things like that. And with him, I was helping him bridge between sovereign wealth funds and Barclays and other opportunities. And that was a great experience. And then I ended up setting up Elkstone, and Elkstone I set up as a family office, starting with Roger as a client and then branching out to many, many other clients over the course of time. So I kind of think I've done my career backwards in many ways, but many chapters, which I think in truth has been very helpful, particularly in the venture space.
Lovely. Thanks for that. The backwards career, we love that. Talk to us a little bit about Elkstone and give us your kind of background on that. You know, what sort of sectors are you looking at? I know you've a number of different areas within the portfolio. What are you looking for? What's your interest in this investment space? What sectors maybe?
Yeah, so look, I think it's probably important that people understand what Elkstone is. So Elkstone is what we call a multi-family office. So we're a business, shareholder-owned, founder-led, but with clients across a multitude of different fields. Most of our clients are either entrepreneurs themselves or they're from professional services, partners in the law firms or accounting firms, etc., or C-level executives. So a fairly strong bench of clients with lots of very different interests and lots of different backgrounds. And as a result, we've quite a wide spread of what we actually get engaged in. Our business is structured into real estate, the family office itself, and venture. And obviously for this call, the main focus is venture. And within venture, look, we're agnostic in terms of what we get involved in. For the reason I've explained, we've different clients with different interests. And just to give a flavor of the type of companies we've invested in, some very notable names that people would be familiar with, like Dollar Shave or Revolut. And then, more local names that have done incredibly well, like Let's Get Checked or Flip Dish, that was in the news last week. And then lots of other names that will be prominent: Soapbox, Mana, Robotify, Evercam, Meatless Farm, Health Beacon, Han ETF, and lots more. But I just mentioned those because those who are familiar with them will understand that that's a very wide spread, from robotics to food delivery to drones to fintech to insurtech to healthcare. So Elkstone very much is a player that's a generalist and interested in all sectors.
And so, I mean, there's some star names inside that, and kind of Flip Dish most recently as last week. Fantastic success stories. Mana, Aero, as you mentioned, with Bobby. At what stage are you getting into the investment in the startup? Are you the early stage guy? Are you a seed fund, pre-seed? Are you Series A? All of the above? Where do you fit in that kind of in your profile?
I find that these, and particularly across geographies, the labels mean different things to different people. So look, in the broadest of sense, we're early stage. An early stage quite literally will be from an idea, and we've invested in ideas and founders and not much else. And we certainly will invest as late as even Series B in terms of where we do our first ticket. But our sweet spot is definitely early stage. I would say my favorite spot is probably pre-A. And I would say most of our deals we do at seed. So seed and pre-A would be our sweet spot, but we do even earlier and we do later.
Very good. Let me just dip into one or two of the questions that people sent in to us in advance. And Ciara had a question for us around, and it probably picks up a question that Breed had for us as well. What point of a company's in development do you consider them ready for investment? In other words, you're looking at that early stage. What is it that's going to spark your interest? They're at that early stage, traction maybe is limited, and you're running the rule over them. What are you looking for?
Well, look, there's lots of things, and it's very hard to distill it down. And people will have heard this many times before. But if I was cherry picking 3 things, and then they vary depending on exactly what stage a company's at. But the 3 things I would have, and they'd be in this order, would be the quality of the founders. And I emphasize founders. I know one of the questions you've got is around number of founders or the quality of the team and so forth. But for me, quality of founders is very important. I much prefer to be investing in 2 or 3 founders than a single founder. It's not that I won't invest in a single founder, but my preference is a couple of founders. So the quality of the founders is the number 1 criteria. What I call the size of the prize. So understanding the opportunity and my own assessment of, and the team's assessment of the opportunity, both in terms of the ability to execute on it, and if there's success, what that success might look like and translate into. And then the other one, which again is just a kind of run of the mill, but it's critically important, is a judgment around timing. Is this the right time? Is it the right time for the opportunity? Is it the right time for Elkstone to be investing? Is it the right time in terms of the challenges? So COVID is a very good example of it would clearly influence whether you think now is a good time or otherwise to be investing in certain sectors, etc., etc. Equally, it will throw up opportunities which might not otherwise be available. But quality of founders, size of the prize, and timing for the particular venture itself would be the 3 key things. And then quality of the founders, that becomes easier to judge the further progress the company is, because then that gives me data and it gives me insights in terms of what's been achieved, what's on the roadmap, and how are they going about executing, what's the quality of the team they've been able to draw in and attract and retain. So the further a company's progressed, the easier it is to judge the quality of the founders, and also to judge execution and timing, and indeed the size of the prize. So that's maybe a variation of that team, but just to explain it, that if it's very, very early, it's a judgment around the quality of the founders primarily. If it's a little bit further on, you have a lot more to judge, and that makes it easier for the investor, makes it harder for the founder because there's more to be tested on.
And just go back to the team for a sec. Domain knowledge, as you're looking at that team kind of profile, importance of domain knowledge specifically?
No, look, it's funny. It can be an influence, and certainly you like to see some depth, if I can put it that way. But look at venture is a great example. In many cases, founders who know the industry really well, as distinct to founders who don't actually know what they're getting into, can struggle. Sometimes the unknown and not knowing the challenges and not knowing the roadblocks can actually be advantageous. So look, I clearly would prefer to have people who have depth and knowledge in the particular sector, but it's not an absolute must-have.
Yeah, very good. Just to slightly digress for a moment, there was this lovely question that Jerry Hassett sent in to us, and it was, what signals can a startup send that have the most negative impact on the investors as you're at that kind of early stage in the process? I thought I haven't come across that question before, and I thought it was quite an interesting angle.
Yeah, look, one of the things I say to founders all the time is that, look, the truth of the matter is they're selling themselves continuously and they're being judged continuously, and they should be very, very mindful of that. So every interaction you're being judged, you're making an impression. So for me, what's a real letdown would be, take something as simple as the first deck. The care that's been taken on the deck tells a huge amount. The way they share the vision and their understanding of the model, the business model they're setting out to achieve. So care, not taking care, not dotting those I's, not crossing those T's. I always love the phrase of, I wrote you the long letter because I didn't have time to write the short one. I like to see presentations that are the short presentations because care has been taken, they've been distilled down. You can see the intellectual capital that's gone into how they've pitched. So for me, that's a real negative if I see a founder as being too casual about how they're presenting this opportunity.
Okay. There's an interesting question just popped up there, and it's around investors are only looking for tech, pharma, med, the kind of the high profile ones. And, somebody is talking about a product-based startup without specifically saying what that is. But there is a big focus in the industry on tech, on pharma, on life science. You mentioned earlier on that you had a wider approach. Are you wider than just some of those, and are you more generalist in your approach?
Well, we're definitely more general, and look, we're in a huge number of sectors. I use the phrase, we like to see tech enabled. Now, again, it doesn't have to be tech enabled, but I do find that, more attractive if it is tech enabled, as distinct to being technology itself. And that goes back to just the understanding of the prize, if I can put it that way. So it's, the more light capital a business is, the more tech enabled it is, the greater the ability is to scale and to have the belief in the team's ability to scale and that business to really accelerate. But Elkstone's definitely invested in much wider than solely tech-enabled type businesses. We're not really focused on what I would call deep tech, though we've done some. We're not deep tech experts. In fact, I would say we're not experts in anything. But, maybe if we're experts, I'd like to think we're experts in picking quality founders, picking the right opportunities, and then working very constructively with those portfolio companies, knowing what we're good at and knowing what they're good at, and giving them the space to get on and do what they want to do.
Very good. Last question on this particular segment around that kind of early stage, and there were two nice questions in from Adele and Emer, and they were around probably similar sides of one, can you get funding without existing sales? Would you look at that? And then Adele wanted to know, I've just a prototype, I'm pre-launch. Is that attractive to investors? So I suppose the question is then around the early stage startup that has a prototype, doesn't have customer validation, doesn't have sales. Is that attractive, or how to make it attractive, I suppose, might be a question.
Yeah, look, I think it's, again, just to be, call it for what it is. I mean, the less advanced you are, the harder it is to sell yourselves and to attract investors. And therefore, if you don't have a product, or if you don't have customers, there's a greater onus, there's a greater challenge on you to spell out why you're such a special opportunity. So it's not that it's a no-go area, but you just have to accept and understand that it's a tougher ask, and there's less people willing to invest at such an early stage. So the more you can bootstrap, the more you can advance, the more you can show, the easier it becomes, assuming clearly it's quality, that you can get those investors in. So, Elkstone, quite literally, I mean, some of our, look, we're very lucky. We've a lot of successes at the moment, and please God, that will continue. But, some of our successes, quite literally, they were an idea when we first invested in them. We invested without the product. We invested without the revenue. And many others will do likewise. But it's easier to do that where it's a serial entrepreneur, by way of example, or it's easier to do that when the founder is absolutely stellar and you just know it. It's that usual phrase, looks like a duck, walks like a duck, quacks like a duck, it's likely a duck. We know, because we deal with it all the time, we know star quality when it's in front of us, and it's easier to back star quality.
Which leads me nicely into kind of, so picking up on some of the investments that you've done and understanding or maybe what you can tell us about it, but you mentioned some of the companies that you've invested in. Why did you choose to invest? What was the X factor in looking at some of those? And if you could give us some examples that kind of you said to yourself, this is for us, this is the investment we need, and we jumped straight in. That kind of star quality inside them. What was that?
Look, I think it's every case is genuinely different, and there are some common threads, and certainly one of them, and I would feel really strong about this in an Elkstone context, is the quality of the founders. But having said that, there's still different variations in every case. Just cherry picking a little list here. I'm just looking at the names. Cherry picking some of them to give a flavour to those listening in. Let's Get Checked is a great example, in that when I first met Peter and Ronan, and they know it, I even have the emails, they have the emails, that, I was very impressed with the two of them as a pair. They were very, very complementary. Peter was cocky. He was cocky, he had a swagger, but he was brilliant. And his vision and his mindset, even at that very first meeting, was very clear and very compelling. So that was a real judgment on the quality of those two as complementary of each other. A charisma around Peter that was very evident, but also a vision that was very clear that there was a real opportunity that if these guys had the ambition and if they could execute on what they saw as their vision, this could be a very, very special opportunity. The other thing I liked about Let's Get Checked was no one else was getting it. Despite what I saw in Peter and Ronan, other investors in the Irish market weren't backing them. So, you know, that to me actually gave me further encouragement that Elkstone could really make a difference. And these two guys were really worth backing. And look, it's been an incredible journey with them. I'm still on the board. There's amazing shareholders, you know, the likes of Cuming and United Health. And, you know, I mean, it's just endless the quality around that board at the moment, where the two guys have brought that business to. But, you know, there's many, many other founders in the Irish ecosystem that I think can, you know, hopefully do similar in time.
Very good. Excellent. Couple of technical questions, I suppose, from coming in on the chat there. B2C only or B2B? Sorry, B2B, B2C. Which are you doing both? One or? What's your preference?
We do both. We do both. I mean, obviously, consumer focus is harder. We've done it. We've had great success in it. We like it. But it's harder for lots of reasons, including the amount of capital that ultimately is needed and absorbed. It's harder to scale, etc., etc. Favors more a winner takes all type market generally. But we have done and we continue to do both.
Good. Metrics. A couple of questions from Simon and Liam there around the importance of metrics, and it probably picks up that piece around the early stage and moving it beyond that. If you're looking at metrics, what are you looking at, or what are you looking for?
Depends on the businesses, but we are, you know, despite what I might call, we're drawn in by the founder, and we're drawn in by, you know, the vision and the addressable market and the scale and so forth. But when we're in, we're very performance driven and metric driven. And, you know, if it's a, you know, the obvious type things we'd be very focused on, you know, lifetime value, CAC, cohort analysis, you know, growth progression month on month, never mind quarter on quarter, customer feedback, all of that would be very important. I mean, if you're in a opportunity that has stellar growth opportunity and are executing in that way, you just have to have your finger completely on top of the metrics. And always looking at, you know, even quite literally when you close a round. So we've closed a round, obviously, with Tiger, with Flipdish, you know, great success to have someone of Tiger's caliber joining the Flipdish, you know, investor table and so forth. But that deal literally closed last week or the week before, and before it even closed, we're focused on, you know, well, when are we going to be looking to raise money again, and where do we need to be in that regard, etc., etc. So you're always looking ahead. You're always 12, 18 months ahead. And what metrics do you need to be showing 12, 18 months ahead to get the next round of quality investors in to continue that growth? Very
good. Thank you. We got 20 minutes in and the question arrived, valuations. How do we decide on kind of valuation and coming to you and pitching a valuation, and how do you look at that, and how does that process work from your perspective?
Again, differs very much on the opportunity. It differs on the set of circumstances. It differs on, you know, who's in the mix or not in the mix. It differs depending on the stage. It differs depending on the geography. So, you know, for those who are in the flow, it's very clear there are kind of what I might call going rates for, you know, seed and Series A type levels, and they even change by geography. So a starter deal in New York has a certain price range compared to San Fran, compared to Berlin, compared to London, compared to Dublin, compared to Galway. So there's kind of broad rules of thumb. It's definitely an art rather than a science. And it's definitely, you know, what I might call competition led as well. So are you the only one interested in a particular deal, or are there lots of people interested? And how focused the founders are on what I might call building a quality cap table, or how focused they are on optimizing the current round's valuation. So it's truly an art. It really is an art, and there's no right answer, but it's about trying to, get the balance right overall.
And is it a negotiation, or do you dictate that process?
Depends on the circumstances. So it would typically be, I would say it's typically a negotiation, but not a hard negotiation. I think, look, people come to you, lots of people come to you with a notion in their head in terms of what they think the business is worth. And if they're, if they're significantly off, it's very easy to have that conversation to say, look, I love the business, love the opportunity, but the valuation's far too high. Can't progress with this. And if they then shop around and try and get that deal done elsewhere, they'll most likely come to the same conclusion, and they'll come back to you. But they'll come back in the real world as distinct to what I might call the aspirational world. And obviously that's at the very early stages. Once you're on your track and you're making progress and the metrics are there to support the business and what you're doing, then it becomes clearer and easier in terms of what the valuation should be at Series A or Series B or beyond. Much easier. So I'd say at the early stage, it's more of an art. And as you go through the stages, it becomes more metric driven and based in reality. A lot of valuations early on in truth have to be grown into. So what you're doing is you're not valuing the business today, you're valuing it based on where does this need to get to, how are we going to bring in more money later on, how are we going to make sure that the founders are protected so that the alignment is correct and not overly diluted too early, etc., etc. So that's how valuations work early on as distinct to fundamental valuations, while later on it becomes much more performance and metric driven.
That's a lovely phrase, Alan, grow into your valuation. I love that. It's kind of this notion of you're at an early stage, you're still testing the water, you're talking to other investors in the market, and you're trying to kind of arrive at it's almost a consensus view that the market is saying this is what the valuation is going to look like, and there may be one or two outliers, but generally the market's going to arrive at it, and then you grow into that valuation, and it becomes more metric driven or financial driven as you move forward. Lovely phrase.
Yeah, look, and if you grow into it, everybody's a winner, and if you don't, then unfortunately we're all losers.
Yeah. So we're in this together. Can I change gears slightly and just ask you about your view of the overall investment market for startups and scale-ups here in Ireland and abroad? Is there money available? What does that look like? I suppose just a sense really of, it's probably the economic climate around, is there money available to startups, and what do they have to do to get their hands on it?
Yeah, so look, I don't know what you're expecting me to say, but quite literally last Friday, I was polishing off a submission to the Department of Finance on the EIS scheme. They have a review underway, and the headline on the Elkstone pitch in was nurturing a vibrant Irish venture ecosystem. And really my message, and we've been working closely with the Department of Finance, that they've been very receptive, in fairness to them, in terms of the soundings we've been making. But my honest assessment is, I think the Irish venture ecosystem, startup system is not in good shape. That's my honest assessment. I say that in the context that, I didn't grow up in what I call venture land. I explained earlier my background. So even when I started doing angel investing myself, most of my initial investments were international because my clients were international. That was the circle I was in. And it's only over the last 4 or 5 years that I and Elkstone together have been investing in the Irish startup scene, and we've done a lot in that space. But I've been disappointed with what I would see, the strength of the ecosystem. I think it has a long way to go. I don't think we have a vibrant angel ecosystem, despite the good work of the likes of HBAN and Tech Ireland and so forth. I think the venture players here are, I use the phrase a mixed bunch, and I don't mean that in an overly negative context. I just mean it by contrast to the deep pockets and the quality of VCs in other international markets. So if I go to New York, or if I go to even the likes of Berlin or Paris or London, I think there's a big gap, and I'm very keen that Elkstone is part of that solution going forward, and not just Elkstone. I think here in Ireland, the more international VCs we can draw into the Irish market, the more we can build up a really true, vibrant angel ecosystem, the more we can have fiscal policy that will support startups in a really meaningful way, the better. And I see it all being, it's about a snowball. It's getting that snowball properly rolling and gathering momentum. And I think we will get there, but I'm definitely not complacent. I think we've a lot of work to do as a country to really get a vibrant angel ecosystem, a vibrant venture system. And there's no good reason why we can't do it, but we need to have a lot of self-help to get there. So I think, look, at a micro level, I think there's definitely opportunity to raise money. I think, good startups will find opportunities to be funded. But I think for the system as a whole, at a macro level, I think there's a lot of work to do.
And so it's that macro level, but is it also a function of the fact that we're a small little village on the edge of Western Europe? There's only 5 million of us. There isn't the capital base in the country to nurture that. Is that a factor?
I think it's a factor, but I wouldn't oversize it. I think, look, there's many angles here, but I think success brings success. And, when we've had, in due course, when we've had, more than a handful of unicorns, when we have what, I guess loosely in the ecosystem is called the mafia coming out of various unicorns and seeding more startups, that will really begin to build. But I don't think we've had that in any great quantum thus far. And I think even at the angel level, we need more angels, and we need those angels having more success. And again, that will feed itself. And we also need, I'll just use, because it's I guess the recency of it, I'll just draw it out again. Tiger coming into Flipdish. I mean, clearly I'm delighted with that from a very narrow Flipdish perspective and from an investor perspective from Flipdish. But I'm more delighted with it in terms of, look, this is the second investment Tiger have made in Ireland Inc. And hopefully it's the second of many to come. And we need more top pedigree funds coming in. And if they have success, they'll come back time and time again. So I just think that's healthy for the ecosystem top to bottom.
And for the startup or the scale up that's on the call here now, looking to expand, I mean, they should be building their network off the island as well as on the island. And you use Tiger there as the example, who've done 2 investments thus far. They're open for business, presumably. They like what they see in the 2 that they've done, and are presumably open for further discussions, you'd imagine.
Yeah, and I think, look, again, I saw one of the questions that you shared earlier around, what should founders be doing in terms of preparing for rounds and so forth. I mean, again, you can't do enough warming up. So, making sure that you're not turning up to a VC or a angel for the very first time with your deck, that you've got there earlier and you've built that relationship. And the more you can do that, the better. It's not easy, but the more you can do it, the better.
Okay, switch track for a little bit, if I may, and talk about IP. And we received a couple of questions in. Richard had one around, how do you value a pre-revenue spin out? Probably a more detailed one from John McSweeney was around IP assignment, and do investors really know what it means? So there is this question around, we do have a research industry that's funding a lot of spin outs that's coming out. EI have through their com fund. There's a lot coming out. The importance of IP to you, I guess, in the investment process. How does that stand with you?
Again, I think it differs greatly depending on the sector or the company, etc., etc. But I've been kind of fascinated with conversations on IP over time, even around board tables and different views from whether it's individual shareholders or from VCs about the importance of IP. And there are definitely different schools of thought. And I would say that, look, it's a tricky space, because until it matters, it doesn't matter. But when it matters, it's critically important. And I think, when capital is scarce, there's always this debate about, well, how much of it should be going into protecting the intellectual capital and the IP, and how much of it should be used for growth. So it is a tricky balance to get right, but my experience, and I'm not saying I definitely don't have a monopoly on this, but my experience is that generally, I mean, there's definitely some sectors where it's just absolutely a must-have in terms of dotting the I's and crossing the T's. But in my experience and the sectors we've invested in, which is widespread, IP tends not to be as important as people traditionally think it is.
So for you, then it's could be then, you know, how fast can you move? It goes back to some of those points: the team, the domain, their understanding of their market, their understanding of kind of their preparedness for the journey that they're about to go on. I accept your point. In certain areas, IP is absolutely crucial, and you need to have it. But generally, I think in the general call here where we're talking about, it's probably a number of other factors, the three that you outlined up top, plus the other ones that we're discussing, that kind of will really maybe make the difference.
Yeah, 100%. 100%.
Okay. Let's talk a little bit about the landscape, the opportunities. So we've talked about the funding landscape, but what are the new kind of technologies, or what are the new opportunities, or what are the hot items that you're seeing coming down the track that are starting to excite you?
Again, I'm kind of reluctant to, you know, fine tune it or be too sniper-like in terms of where the opportunities are, because, well, for lots of reasons, but as a kind of overriding observation, I'd say, look, there's always opportunities, and they're from all sorts of different spaces. But look, where do I see more flow? Where do I, if I was a founder, and I was, it's not the right way I think to think about things, but if you were scratching your head with a whiteboard trying to figure out, well, where might you look to make progress, I think there's obvious areas where, you know, there's going to be a lot more change happening. You know, certainly the application of machine learning, automation, robotics. There's huge opportunities in those spaces, and probably not as much happening in those spaces as I think there ought to be in an Irish context. I think globally healthcare is just phenomenal opportunities, and COVID has certainly accelerated that, and the need for care at the point of need, as distinct to in the hospital system, is driving huge changes. Therapeutics and diagnostics, etc., ed tech, and the whole food delivery space, despite, you know, all the big successes that are there, there's still lots of opportunity in that space. So I honestly just think it's endless. And then look, there's other spaces which, again, I think in an Irish context, we're not well placed at the moment. But, you know, I'd be a huge fan myself of DeFi. I think DeFi is going to be transformational. And that's a space where I think it's very tricky to identify your winners. But there's definitely, as a sector, there's going to be tremendous opportunity in the DeFi space and blockchain and so forth.
And has, from your perspective, there was one or two questions came in about kind of the pandemic and this kind of strange world that we've been living in for the last 12 months. Your take on that, has it had a significant impact on the startup process? And second part, do you see that continuing into the future? I mean, we have a vaccine rollout underway, getting started slowly, but you know, we will get to a point at the end of this year. Does the impact of the pandemic stay with us in business?
I think it will, and I think it will depending on, to different levels, depending on what business sector you're in or what opportunity you're progressing. So again, just to spell out some obvious ones, I think, you know, it's black and white. It's black and white internationally, and it's black and white here in Ireland. That, look, there's certain sectors that have really struggled at the moment in terms of getting investment into them. So the obvious ones being, you know, retail, hospitality, leisure, travel. Anything in that space, it's a real struggle to get meaningful capital at this point in time, because, you know, investors are wary, regardless of how good they think the opportunity might be in what I might call ordinary circumstances. And then I think there are, you know, certain sectors that are, you know, have accelerated, and it's very clear that there's tremendous opportunity. And even if we go back to some type of, you know, past normality, and that acceleration is going to continue. So ed tech is probably one of those, you know, digital in the classroom and so forth. And And then I also think that, there's, even if you take something as simple as, communication tools and at home productivity, that's a sector that I think is going to continue to have lots and lots of opportunity. So I think COVID has definitely had its impact. I think it's going to continue to have a lingering impact, but I think it will differ depending on the sector and the business.
Yeah, I think I'm with you, and I think it's changed. I don't think we understand fully what that change is going to wash out like, but the world has changed around us, and I think we're probably in the early stage of kind of exploring that.
I think the other thing it's done, I think the other thing it's done, and again, you just never know. So, if I go back to last March in Elkstone, and we have a portfolio of over 50 companies, and I just wouldn't have been what I might call super confident about how the following 12-month period was going to play out. And and I don't think this is just representative of Elkstone. I think this is actually representative of the global venture landscape. I think the portfolio has been very resilient, and obviously within it you have some obvious casualties because of the particular sector they're in, and you have some obvious winners because they happen to be in the right place at the right time. But what I call the belly of the portfolio has actually been very, very resilient in very difficult circumstances. And I think that goes back to the quality of the teams you invest in, the quality of the founders. But startups are very good at adapting. They're very agile. So I think if anything, COVID is probably spelling out that ventures and startups in particular, you can do a lot with very little. And I think even founders 12 months ago compared to today, or today compared to 12 months ago, would much better understand that themselves. What they can achieve with very little is actually quite amazing. And actually, it is true that sometimes when the back is against the wall, creativity and innovation just multiplies. And I think that's been an interesting window over the last 12-month period.
Yeah. We didn't think we'd spend 12 months at home locked up or learning to sell virtually or trying to get customer validation without meeting customers. So the ingenuity and the innovation that's been displayed, I think, has been kind of a revelation for all of us. Can I ask you a question which Gary submitted there, and it was around exits, and the ultimate objective, I guess, for you is to exit the company, and what does an exit look like for you, and what sort of upside are you looking for as an investor? If I was pitching to you and kind of describing my potential 5-year valuation with the upside for you and stuff, and again, it's there's no one size fits all, but typically, what are you looking for as an investor in terms of exits?
So again, it's very important to kind of just spell out Elkstone being, not typical of your venture landscape. And I say that because within Elkstone, there's a number of different pockets that we invest from. So just to be very clear, we have our venture club, and our club, when it invests, it's a different set of investors in each individual deal. And it's those investors investing in something that they truly believe in themselves. So it's not a fund. It's a one-off opportunity, and those investors are investing in that one-off opportunity rather than in a fund itself. I personally invest, and I have the European Angel Fund investing alongside me, and I'll have, I obviously want to manage what I might call opportunity for the venture club, but I also want to manage where I might put some money into things that I would think are not the right fit for the club at this particular point in time. And then Elkstone will have a fund, all going well, later year. So the criteria in each of those is going to be somewhat different. And one of the big advantages we have in Elkstone is that we don't operate in the traditional fund sense of, look, anything we look at needs to give us a sense of a 10x or a 15x type return. We have and will continue to invest in opportunities where we feel quite good about the probability of maybe a 3 or 4 or 5x. And I, look, we're because we're a multifamily office, we do lots of things. We're very familiar with public markets, et cetera, et cetera. We're very familiar with private equity. And one of the things we love is what I call asymmetrical opportunities. And we will see, venture is high risk, but as a portfolio, it's less high risk. And we'd be very acutely aware of opportunities where we think actually the downside is actually very limited, but the upside might be contained, that we don't think it's going to be a 10 or a 20x, but we think it's comfortably going to be a 3 or 4x. And our portfolio as a whole tends to surprise us that actually what we thought might only be a 3 or 4x, but certainly wasn't going to blow up, actually ends up being much better. So again, no rule for all. It differs on a case-by-case basis. Thankfully, we've had ones that have been far in excess of a 10 or a 20x. But equally, we've had ones that we'd won a couple of weeks ago that delivered 2.3x. We weren't delighted because we would have liked to stay with the company for longer. They were sold. They saw a wider opportunity emerging with somebody else. We were very happy for the founders, very happy for their ongoing journey. We did 2.3x, but that was an 85% return over a couple of years. So you can take it that our clients were extremely happy with the exit. But we're happy to be in for, and I say it very clearly to founders, Elkstone as a club, different with a fund, but as a club, I and our investors are very happy to be in investments for 10 plus years. Equally, we're happy to back ventures where it's a 3 or 5 year journey. So again, no one size.
Okay. So then I'm coming up against the clock. I have a minute or two left with you, Alan. Can I ask you, because it talks to a little bit at that point, about the process of contacting Elkstone, understanding what it is you want, you understanding me, you doing your due diligence, and us agreeing that, yeah, look, we like the dating process and we're going to get hitched. What does that look like from your perspective?
Again, very hard to describe because it does differ. But very broadly speaking, look, we have a dedicated venture team. The team would be well known, I think, around town. You can approach anybody within the Elkstone team to, engage. And one thing we're very good at, I think, look, there's lots of things we're not great at, nobody's perfect, but one thing that we are very good at is we don't mess people around. So we're very quick at deciding whether something looks the right fit for us and for our club. If we decide we like something, and it just depends on how much we're juggling at any one time, but if we like something, we can open up the dialogue and be done quite literally within a month.
Very good. And open to, like, for people on the call here, I'll find your website. I looked at it this morning. I can contact you. I can contact some of the team. You'll engage. There's often this fear that I shouldn't go to the VC. I shouldn't go in until I've every single thing mapped out. But my sense is you'll take the coffee, or you'll take the virtual coffee. You'll start to explore the opportunity very early on, and then point yes, no very quickly.
Yeah, the one thing, just to caveat it, is, so look, and again, I'm not exaggerating. Elkstone's completely inundated with deal flow. We invest in both Irish and we invest globally, and we're very well connected with global VCs, and they're keen on Elkstone co-investing with them as well. So we're completely inundated with deal flow, and therefore, I think the key thing is to reinforce that if you're going to approach Elkstone, you should be very considered in terms of making sure you're going to create that impression. You want to create a good first impression. So that's my one caveat. If you're going to approach us, just make sure you're going to best represent yourself in that interaction. So for us, it's always helpful to get a deck. It gives us a really good insight into how you're positioning yourself, what the business opportunity is, and it gives us something credible in which to have a more considered engagement with that founder when we have that first call.
Very good. Alan, we're over time. Can I thank you for the call today? Apologies if we didn't get to all of the questions. I think we broadly covered on most of the main thematic areas. You were very honest and very realistic in your kind of discussion of the investment landscape. So thanks a million for that. And with that, thanks a million, Alan. Really appreciate your time, and we will see you all again soon.
Great. And thanks, Dublin BIC. Great as part of the ecosystem.